Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results. Good morning, everybody. Welcome to Develop Your Edge. My name is Jim Cagnino with NinjaTrader. It's February 22nd, 2024, Thursday as usual. I am the co-host. Joining me live right now, Anthony Crudele. Good morning.
Jimmy, how are you? Great to be here. We got two Italians in the show today. I'm sure Tom is very jealous.
Well, it's like, are you sure you want to trust me being a co-host with Anthony? Are you positive? And they said, yeah, sure. What could go wrong?
This can go so many ways today, everybody, so many ways. But we're going to go the way of natural gas. And maybe we'll talk a little bit about NASDAQ too, just because why not? After NVIDIA, we might have to talk a little bit about it.
Absolutely. Well, the good news about natural gas, it comes in a couple of different flavors, right? We got the classic size contract. We got the micro contracts now.
Yeah, I mean, I think today we're going to focus on the micro natural gas, and I'm going to talk about why I think this is such a great product for people that are wanting to get involved in trading, natural gas, energy markets. They got them for micro crude oil as well. This is a relatively newer product. CME launched this product, and it's $1 per tick. It's the Henry Hub natural gas. So it's just a smaller version of the bigger natural gas product, which anybody who's traded it knows that for that size of a product, you really want to know what you're doing, because for the big natural gas, look at how much it's moved. I mean, natural gas was what, when we look at the chart last year, $9, and it's down to $1.70. And you go, it's a pretty big tick value for the big natural gas. So a lot of people talking about it on social media. And I think that introducing them to the micro natural gas is the way to go, because it's just, once again, Jim, it's a better way to manage your risk. And I know watching your show that you have here on the Ninja Network a lot, you're always talking about managing risk. And it's just so important that you get the right product size. And I think that especially for retail traders, I almost think exclusively, most of you, unless you've got pretty big accounts or you've experienced trading energy markets, specifically natural gas, you probably use the micro.
Yeah, and I like to tell people the micros, just think fractional shares, right? And it doesn't have to be just a one lot. You could do a 2 lot, or you could do a 4 lot, right? A percentage of the classic contract to match your account size and your risk tolerance.
Yeah, I mean, that's the thing with the micros. I've said this even for a lot of people that are trading NASDAQ, you're probably better off with the micros. You can get as big as you want. I always look at it this way. The more volatile the product, you don't want to be price sensitive, right? And if a product is very volatile, and especially with a product like natural gas that's got the big contract is $10 a tick, it's pretty decent tick size for the average range that you're going to see on a daily basis. You want to be able to absorb the price action with your positions, right? So if I like a level of natural gas, I don't want to trade all at once at one price. You want to be able to work your way in and work your way out. And that's why I like these micro products. They're not just for the traders that have smaller accounts or are newer, but they're for traders that maybe want to be able to get in over over a wider price range. And I think that's where the micros get really interesting in here. Maybe, let's pull up the chart and let's take a look at natural gas. And so natural gas, another thing that we want to mention, first of all, you got Henry Hub. This is CME Group's natural gas contract. This is really, we used to say in the S&P pit, the S&P futures was the center of the universe. When you look at natural gas, Henry Hub natural gas is really the center of the universe here in the U.S. That is the product to watch when it comes to natural gas. So this is a product that, if you're wondering how it impacts your pricing, if you're looking at your gas bill, if you're in the Upper East Coast, down here in Florida, we have electric. It might even be powered by natural gas. This is the product that you're watching. And what's interesting about natural gas is it's very local. I've done a lot of these podcasts on this. Natural gas little different than crude oil. It's just much more of a local product. And this is really the centralized pricing for it with this Henry Hub. Now, when you look at this market here.
Well, by the way, Anthony, if I could just kick in really quickly. So the timing is perfect here because we just had that EIA release, right? The Energy Information Administration inventory release just came out, and that's a major driver of price sometimes, right?
Yeah, absolutely. And, that's the one thing we should talk about too, even before we get to the chart, even though we're on the charts right now, is number one, these products, they roll much more frequently. Every month, you got a new natural gas, same with crude oil, a little different than you had the equity indexes that rotate every quarter, right? You got March, SEP, June, DECE, all the different products, months for the indexes. These products roll more frequently, and they're going to be moving off of different data points, just as Jim just explained. EIA's big number every week you have it. This week we have a shortened week, obviously, because Monday was President's Day, so it moved to Thursday, typically Wednesday. But these are markets. When you start to trade these markets, you better have your eye on the calendar, because when you're looking at commodities, especially energy markets right now, they're going to be moving on data. Even if the data is a small number, you're going to have volatility in it. And so make sure you're aware of it. Glad you brought that up, Jim. And when I look at the chart here on the daily, let's face it, natural gas this has been a topic of conversation a lot on social media lately, even for those that probably don't know much about natural gas. And I'm no macro expert on it myself, but a lot of people talking about it, because people are looking for trading opportunities because of a market like this that's moving as much as it has. You can see here, I pulled up a weekly just to get a really big, wide perspective of this market. When you go back and look, wow, what a move, right? When we get to the daily, I'm going to look at the daily. It's a little condensed here. I'm going to remove this indicator that I have up on here. We don't need to see that right now. I'm going to focus on Bollinger Bands, and I'm going to look at the anchored VWAP from the beginning of the year. Here's something that you want to watch, and this is where I thought was actually very interesting that I saw coming in this morning, getting ready to talk about this show, is everyone knows I like to use the Bollinger Bands as a guide. Anytime the Bollinger Bands, everybody, when the mouth is open, volatility is expanding. When Bollinger Bands finally start to get flat and come inward, which we've seen the top Bollinger Band in natural gas do this. Now the bottom has gotten flat and starting to come inward. What does that tell you? Potentially mean reversion. Now you had a recent roll from March to April, which is the J contract in natural gas. It's moved to April, and you saw a little bit of a spike in natural gas because the April contract, even though March is still listed, April is now moving into going to be the primary trading one, which you see here over here on the right on Tradevate. That's MNG is a micro J 4 for 24. You see that the market on a continuation chart on a daily, these Bollinger Bands are starting to come inward. Now, what's interesting here is we had this gap because of what happened with the roll. And so it gets interesting. It's technically really not a gap, but it is when you're going to look at it over a period of time. If you're going to look at a continuation chart, you could actually remove these gaps if you choose to. But because natural gas is moving every single month with a new product, I like to look at it just on this perspective and say, okay, price has now jumped a little bit compared to where it was, right? Because you had the closeout of March. Is this thing going to be a mean reversion month? What I like to do is, first off, take a look at where we are relative to the auto-anchored VWAP to the beginning of the year. And I talk about this a lot. You can see this is a very negative year. If I'm not mistaken, I think natural gas is down the most over any commodity right now. So number one, you don't want to be in a hurry to try and pick a bottom, right? Everyone looks to try and buy the falling knife in natural gas. And that's just, not look at what it's done for this period of time. And this thing just keeps coming down, and it can happen to the point where it goes to, who knows, it can go to zero, and who knows, it can go negative, right? We've seen this happen in crude oil. So ultimately, when you've got to take delivery on a commodity, you've got to be aware of that. But what when I look for is, once these Bollinger Bands start to come back in and get a little bit flat, I then take it down to an hourly chart, and I start to look at where are we based off of an anchored VWAP off of the high and the low. And the reason why I like VWAPs is because it's the average price, okay, average weighted price with volume, right? So you have the ability to see, is the market longs winning any battles? Are we holding above the anchored VWAP to the recent low? Can they hold above it? Can they push above the swing high VWAP? Can the bulls get any victory? And what you see today is 1, 2, 3 hours in a row, we've hit this anchored VWAP to the low. I showed you on the daily how you're starting to see that Bollinger Band coming in. And now you take it down to an hourly chart, and maybe I'll bring you in here, Jimmy, and see what you think and maybe what you're seeing. The bulls have had a small win here.
Yeah. So, when I look at this chart in that gas, I think it looks like a Japanese yen chart, just like you said. Just when you think the bottom is in, no, it's not. It just keeps going and keeps going. So that's kind of number one. So the bias, of course, has been bearish, right? That's the long-term bias. But right now, just looking at your chart right now, we have looks like a pretty decent area of support also brewing around 777, maybe a little bit lower than that. If you kind of go to your early morning kind of sideways action. And so we're bouncing off against that. And I'm wondering if that's going to hold. There we go.
Yeah, and so I keep taking it down in time frame. Here's the one thing that I look at anytime I'm trading a commodity, okay? The top-down effect. We look at it in indexes. I always start off with the dailies. I think most traders do in their preparation. You start off with a daily or a weekly, and you work your way down in the lower time frame. Higher time frame in commodities, especially you have to have the understanding that the biggest players in this market are not short-term day traders. I mean, the people that are playing the natural gas market that are trading this market are trading it on a much larger time frame. The biggest players in the space are using spreads, they're using options, right? And this price on the front month is not as significant as we may think as a short-term day trader. There's so much going on. You have contango, backwardation, all sorts of things impacting future price and delivery because this is a commodity, right? And so it's a different perspective than your day traders market that you're going to see with S&P and NASDAQ, to where some people may never look at a daily on a NASDAQ, and that's okay. But with this market, you really got to kind of have, I think, that bigger perspective, and you want to widen your time frame a little bit because you want to be able to understand the overall primary trends of this market. Because just like Jimmy said, with the yen or these bigger markets, these currencies or commodities, these things can trend in one direction much longer than you think. Maybe kind of like the NASDAQ too, but ultimately.
Yeah, so Anthony, though, I'm sorry to interrupt, but from a day trade point of view, though, I mean, you could look at the chart you have up and you could see support and resistance levels, you could see trends, and you could see retracements in addition to your Bollinger Bands and VWAPs. It's very tradable.
Very tradable. And this brings in, how do we approach trading it? And so what I like to look at is the same thing I look at on the similar time frames, but I want to have that overall perspective. Number one is we set the daily well below the anchored VWAP for the year. Bollinger Bands, because of the change of the contract, kind of showing possibilities of mean reversion. Then you go to the 30-minute and 60-minute, you anchor some VWAPs to the recent lows, and you can see that there is some stabilization, I will call it, holding above these levels. Now, how do we trade it? And we're going to take it down even to the shortest time frame, which is going to be a 3-minute. And what I'm going to look at here on the 3-minute, and this is really something that I stay very true to and I'm very consistent with. When you look at the Bollinger Bands and you have a market that's in a breakaway downward move, the only time I will look to buy a market is holding above an anchored VWAP, and I start to see those Bollinger Bands start to come in. And now what do I mean by those Bollinger Bands coming in? And this is just even as simply as a 3-minute chart. Look at right here this morning. The Bollinger Bands came in. We held the VWAP. You saw a rally. Okay. Bollinger Bands started to come back down now. We're at a VWAP, but that Bollinger Band is not in. When that Bollinger Band starts to come back in, that's like a warm blanket on a cold day because it shows me the possibility, right, of mean reversion, right, consolidation. And anytime you have a market that has a strong primary trend to the downside and you get to these shorter term time frames and you see the mouth of those Bollinger Bands opening, this thing can just keep trending today. We don't know when it's going to stop. But when we start to see showing signs of holding a VWAP and the Bollinger Band were to come in, then I step in, and I know I could step in with a long that's, I'm going to say, relatively cheap risk. And when I say cheap risk, because once that Bollinger Band, if it comes in and it holds above the VWAP, my stop is going to be relatively tight. Cheap in terms of price, your position size could be as big as you want. So it could be a large position for a short risk. And so that's what I look at, Jimmy.
So would you use a breakout below the Bollinger Band as a signal to get short, as an example?
So what you mean if it were to get below the bottom Bollinger Band?
Yeah.
No. So the thing is with Bollinger Bands, it's so funny, and I'm glad you bring this up. And Tom and I have had this discussion as well. Now, I don't use Bollinger Bands in the traditional way. I use them simply as a guide. It's the starting point of my position. It just tells me environment, right? From the daily on down. Anytime I see Bollinger Bands that are open, it just tells me that we're expanding. Volatility is expanding. So in my mind, I think don't fade, even if we break it or if we were to come down and get below it. Does that mean we're going to continue to see some sort of expansion? It's the reason why I don't is because it's hard to manage the risk on that side of it. And so anytime that I look to go with trend, I am trying to more go against the short-term trend to go with the longer-term trend, meaning this, that if I want to be short today, I'm just deleting a bunch of stuff on here. What I want to look for is this scenario right here. This is the scenario. Because anytime that I have a market that goes up, gets back below a VWAP, and this is just anchored to the swing high, and that Bollinger Band comes in, now I just think, what are we going to do? We're going to play in between the two VWAPs. And the reason why I anchor to the swing high and to the swing low is because it gives me that perspective. Once again, I want to see who's just winning price battles. I'm not a super complicated guy. As you know me, Jimmy, I'm not. I like to look at really just directionally. Do I want to be long or do I want to be short? Right now, in the short term, you want to be selling the rallies, even though it looks like, yeah, maybe we might be somewhat rounding out on the daily, somewhat rounding out on the 30 or 60-minute chart because we're holding this VWAP and the Bollinger Bands are coming in. But on the short term, you can see the success rate for the longs is very short-lived. Up to a VWAP, Bollinger Bands come in, bang, they come lower. I mean, you could see this over and over again. So I like to sell the rally, not try to take advantage of selling into a break.
Yeah, we talk about that. We use harmonics to kind of wait for a little bit of a retracement back up from a fib point of view, and then go with the trend. The other thing I'm noticing here is you got like a triple bottom a little bit on the last chart you just had up, the last time frame that you just had up, which is kind of interesting. We'll see if that breaks through that area of support.
Yeah, and see, so I even took it down to a 1 minute, and once again, the only thing that taking it down from a 3 minute to a 1 minute is, I mean, I'm just getting more bars to see within that 3 minute action. It's not necessarily changing any sort of perspective. I think that's just something that's even important to remind ourselves is that if you lower a time frame, you're just getting more to see on the chart. You're not necessarily shouldn't be changing your bias too much because any indicators that I'm looking at, unless I'm super, super short term, which I'm not, really should give you that same perspective. It's just seeing more within the bar, we'll call it. And just like Jimmy had said, you're failing to hold here. And so this goes back to why, when you look at it, it's like, okay, now what's interesting is this. So you see how it's expanding, really. Look at how this thing is moving right here. And I just screwed up the chart there. But ultimately, what you're seeing is we're breaking below that Bollinger Band is what Jim had already talked about. And I think what's really interesting, going to be interesting about this is, let me just remove this and remove that back. So what we'll look for is, just get that set. All right. What we'll look for is any sort of rally back to this VWAP. If the Bollinger Band is still open, I'll probably look to get shorted. That would give me a signal to short it.
So Anthony, right now, just on this chart view right now,
look at this breakout, man.
It looks like the Bollinger Bands are opening up right now. It's almost like an abrupt turn.
Yeah. And you look at this thing right here. So now it kind of goes back to where Jim, we probably should have took that short, breaking below it. But now what I look at, what's interesting is that, so here's something to keep an eye on. And then maybe we get an opportunity here to sell this rally. See how this Bollinger Band at the top is starting to open up like a V and the bottom is dead open, right? What could be happening is somewhat similar to what we saw back here. What we want to do is, how do we manage risk in these types of scenarios? So 1.77, that's actually a lucky year. That's the year I was born. Is that, Jimmy, do you ever do that? Do you ever look at a price and go, man, I was born that year? Something like that is like the craziest things. You're like, or that year was a good year. And you're like, oh, maybe that's going to be a price that maybe works. What I'm going to do is I'm going to look to sell. This is actually relatively, once again, I say cheap risk, meaning that if I were to start to scale in short here, I would be able to have a relatively tight stop. And so I always believe in the rule of three. I like to scale in with three. I'll put my stops in above this swing high. So in case it blips up, so above 91. And this will be interesting because if we could blip back up to this VWAP, which is held, this is that breakout area. This would be the retest of the breakout and that VWAP. Let's see if it can hold. Now I'm scaling in at and below price. Now, why would I do that, right? Some people will say, well, do you want to wait and see? I don't have order flow tools up here today, but in a market that's trending down, I like to sell at and below price. What does that mean? It means that if I want to sell 1.777, I'll sell at and below it. Why? Because the trend is down. If the trend is up and I'm looking to get short where the primary trend is up like the NASDAQ, I would sell at and above price. So it's psychologically in my mind, I always think to myself, if a market that's really weak breaks out and it comes back to retest a pivotal area, sell at and below. If a market's really strong, okay, and I want to get short, I don't want to sell that first retest of it. I want to watch it and I want to sell at and above it, closer to my stop. So to me, that's why you have to have a range of execution. It's extremely important. Natural gas is weak. I'm using the micros here on the right. I'm going to look for it to rally up and I'm going to look to sell the rally. Okay. And I'm going to use a tight little stop here. I was trading a few of these earlier. I was down like maybe 50 bucks. I bought something earlier and I was just keeping everything relatively tight. And I think with this market, it's one of those things where I'm going to keep my stops pretty tight. And if it starts to get a runner, you let it go, you know, and maybe I get filled and we'll look for when I would start to cover it and let's start to plan ahead. What's interesting is I'm probably going to have somewhere around 16 points of risk. Okay, when all said and done, when I'm into this trade, because my stop's at 1.792, let's just say that I'm an average in at 75 or 74, 76, somewhere there. Depends on where I get filled, right? So let's just call it 16 points. So let's just say I get in an average of 76, 75, and the market comes down. 1-to-1 risk for me is going to be 60. So what I'll do is I'll take one off there. I'll leave two. And then as this Bollinger Band stays open, I'll wait for this Bollinger Band to start to come back in. And once that Bollinger Band starts to come back in and the top one were to start to come back in, I would let the market guide me out because I don't have a specific target. Sometimes I'll look at previous, real quick, Jimmy, previous peaks, as you could see here that they kind of hit here and held. Those previous peaks I consider unfinished business. I'll look at those as well.
Got it. So in a scenario where let's say you get all three units, right? You're short three, and then the market goes the way we think, and it breaks down. You're gonna take off one of the units, right? And so you'll have two contracts left. At any point in that time, would you move your stop to break even or some other level?
I really don't. You know, the reason why, here's my reason on the break even scenario. If I like this area, then I got to manage the trade after it already respected the area. The last thing I want to do is get ticked out when it's still validated, right? So what makes this trade unvalidated for me? And what makes it unvalidated is just getting above. I'm going to remove all of these right now. Okay. Just to get a cleaner look. And actually I'll go back and re-anchor those because I deleted that one. What removes it for me is what unvalidates it is getting back above, you know, that VWAP. So I'll anchor it to this recent swing low and I'll reset to the recent swing high. And so to me, that's what unvalidates it. Okay. I'm going to go back to my 3-minute. And so we get really close right in here. So that to me is where it's invalidated because I got to give it a little bit of room. If it just blips up into somewhere in here and it comes back down, it might still be good. I don't want to overtrade it, right? The only way I would move it to a break even, the only way, it wouldn't be on this specific look, but in any almost instance, would be a situation where I like the area, but I felt it was teetering on it. And I don't feel that it's not that significant to me. I kind of like got my way into a small position that ultimately I looked at it and said, this area just could be a back and forth, like a two-way type trade where I'm like, okay, opening range high, I got it in at the VWAP or one standard deviation. And I looked at it and said, it's a weak hand. So I'm in a small position. I might throw that in a scratch because I don't want the market to whip through. And, you know, I don't have a very strong conviction. Here, I feel like if it stays below this swing low VWAP, I mean, who knows? We said it before. Who knows how far it could go, Jim?
No, I hear you. And there's nothing worse, in my experience, than being what we'd call wicked out of a position because the stop was in the wrong spot. And then the market goes exactly the way you thought it was going to go.
100%. And that's why I said I'll take 1-to-1 off. So I'll take that off the table with a third of it. This is why I like a 3-lot. Goes back to why I think micros are a good product. For example, if I were to sell 3 at 75 and buy 1 back at 60, and it would go back out and stop me at 92 or 91, whatever, right? I were to lose equal. I'd really only lose on 1/3 of the position. I'd break even on 1. I would actually win on 1, lose on 1 at the same price, which would be a break even on 2, and I'd lose on 1. And so ultimately, to me, that's how I manage the risk versus trying to, get too much out of it, or just, I don't think too much. Once again, I like to think very little. That's why I always do the rule of 3. And if I'm doing 10 or 9, you know what I mean? I'll try to be on a 9 because I'll do 3, 6, 9. If I get to, 20, a lot of times I'll get to like 21 or 24, or more. I'll get to 30 and I'll do 10, 10, 10. I mean, I do that because I like to get my 1-to-1 out of a third as fast as I can, obviously. We want to, because then I'm really only managing the position for 2/3. And that is one of the biggest reasons why I almost never, rarely I should just say, because nothing's never, put a stop to break even.
Makes total sense. Would you always do 3, or would you do 4 or 6 or 5, depending on the situation?
Well, I always am doing the rule of 3, meaning I'll break a position down to into a third. I mean, if I end up getting, a lot of times, if I get to a 4-lot, let's just say I'm trading like, NASDAQ, the bigger NASDAQ, a lot of times I'm just like, I get a lot of either partials or I only get a portion of it on. So I get to like a 4, right? What I'll do is once I get that first third, I just buy 2 back. I take more off on an odd number and I will leave half, right? Because to me, I want to try and always, in any situation, take off as much as I can with the ability to protect the risk, but also to maximize profit.
Makes total sense. Makes total sense. This is great. I mean, I love the fact that the CME came out with all of these micros are great, right? No matter what market you're looking at, no matter, pretty much all the major asset classes have them, and they give the 2 things. One, to do this type of technique, right, where you could go ahead and have a 3-lot going at different prices. But also, if you're brand new to a market and you want to get some muscle memory and kind of figure out how it works every day, this is the place to be.
Yeah, I mean, I know as we close out today, I really don't think any newer trader to the energy market, it doesn't matter how much money you have, should not be trading the bigger product until they test their strategy with the micros. The micros have solved a lot of things in terms of risk, but they also have allowed people that can afford to trade a bigger product, trade it in live markets versus sim markets. And so I think that there's just a lot of benefit when you're new to the energy space. Specifically today, we're talking about micro natural gas. It's a great way to test a strategy, even if, like I said, you have the bullets to be able to trade the bigger product.
Awesome. Well, we're getting up against our time here, and I know you're like, all right, next week Tom will be back, thank goodness. But what else do we have to talk about here at the very end?
That's it. You can go to cmegroup.com to learn more about micro natural gas. And to me, once again, we've explained, I think, the positives of looking at this type of product. So with the natural gas market on the move the way it is, go to cmegroup.com to learn more. And of course, you could chart it on Tradeovate. You could chart it on Ninja. And today we actually use TradingView, which you could actually access your Tradeovate account on, which is pretty cool.
Yeah, absolutely. And I forgot to mention earlier as well, Anthony, the maintenance margin for this is $550. Right. So it's a small maintenance margin. So in the event that you wanted to do more than day trade and actually hold positions for a longer period of time, it's a reasonable margin.
Yeah, I'm glad you brought that up, and we end on this. I think, once again, if you think that natural gas is going to have a big move one way or the other, make sure you look at the months out, because once again, as it expires, but this is to me, the best way to hold a longer term position in a market that's as volatile as this. I mean, you could trade this. It goes back to what you said from the beginning, Jim. This is, you're allowed to really precisely manage your risk with the smaller amounts, and you get as big as you want in that position. So, if you're going to be holding stuff overnight, I like to get my beauty sleep, Jimmy. And so I probably would rather have a micro on. I don't want to wake up to a natural gas up or down 200 or 300 points. Not fun.
Yeah. Well, you look great. You look like you get plenty of beauty sleep, Anthony. I just wanted to throw that out. At any event, how can people reach out to you? What's the best way to find you?
Definitely go and check out anthonycrudele.com. Just refresh the site. Really excited about it. Anthony Crudele on Twitter. Watch for the fakes. And if you're watching Develop Your Edge every week, make sure you go and check out our Discord. I write a morning note that's free every single day. I put out a note. We have a commodities channel. We have metals channel. We have index channel. A lot of great traders, a lot of fun people in there. And just once again, watch out for those scammers in there. They seem to be everywhere these days. But you can check out the Discord. Once again, it's free, and we've got a lot of cool stuff going on there. So that's where you can find us.
Very awesome. Well, thanks for your time today, Anthony. Greatly appreciated. I'd like to thank the viewers for popping in here with us as well. And I do want to remind everybody, most important message of the day, please be safe out there. Be good to each other. We'll see you soon.